So that was favorable for this trade. What happens next is not as favorable. We are in the September, so we already have some slight deterioration. Yet we are in the stock that is a leadership stock. That's number one. Secondly, that shows a correct Wyckoff structure, both in the trading range and also in the uptrend itself. And we are at the point of the support, which I'm interpreting as phase C. I'm entering position intraday on this bar, which acts as a potential sign of strength bar, suggesting that there's going to be a continuation at least to $70. And instead, the price just reverses. It reverses in a specific way. We're still thinking that the sign of strength is developing here, and then a backing up action, a smaller reaction, which should come to the support and then reverse and continue to the upside. And this is where the failure happens. So this bar right here shows that failure. I'm not necessarily closing the position right away. I'm thinking, well, could this be that this phase C was not phase C, but we still were in phase B? And could this be a potential phase C? Not a lot of supply comes in, like we've seen, let's say, here. So that was the point of the hesitation. I felt good when the price recovered, but it recovered to the same levels of resistance that we've encountered before. And once after the lower high, we have the next failure, I'm out. And actually, I think that, in my opinion, and I tell my students, that this is a good trade. And again, in your minds, you might be thinking like, wow, what is he talking about? Why is this a good trade? It is a good trade because you give yourself an opportunity to profit from a continuation of an established uptrend. And if you fail, then you just need to quickly close that position and just get out with your risk management. I'm not losing more than I need to, but I give myself that opportunity, and it just didn't work out. The next trade, so if the first trade was a good trade, or the best trade, or a perfect trade, well, not the perfect, the exit was a little bit premature. The second trade was definitely, I would call it bad trade. So what is happening here? So I think I'm being emotionally caught up here in the previous trade, and I'm playing the earnings. So entry number 5, which actually was preceded by entry number 4. So entry number 4 on this bar right here was an entry pre-earnings. It was a day before earnings. So my analysis shows that there should be some kind of positive earnings. I just don't know what kind of reaction is going to be to the positive earnings. In the bear market, the positive earnings sometimes could produce a negative result. And the institutions will be selling into the strength of weak hands that are trying to react to positive earnings. So therefore, I'm just basically wrong on this entry. But I think where I'm kind of proud of myself as to how I managed that mistake was by recognizing that the earnings day itself has elements of the selling climax. We have an increasing volume signature. We are coming to the point of support, which was defined already by 3 points. So it's a legitimate downtrend. And if this is a selling climax, then we could profit from some kind of reaction to the upside. Each time when we have a climactic action with that increased volume signature, increased spread to the downside, we know that there's going to be some attempt to go up. So what I'm trying to do and compensate for the loss, which I still have as a position, is that push to the upside. And it happened exactly in the way how I was thinking it would. I didn't knew that we're going to recover that fast, and this bar was really good. And here the question becomes: is in the environment where the bias is to the downside, an attempt to commit to the upside more times than not is going to become an upthrust. Same here in the same spot. So once the upthrust develops and the price quickly comes back below the resistance, there is no reason for me to wait, and I'm closing the majority of my position. Now, I left some, and this is just a negligible position, but still, I wanted to see how I would manage it. And as the price goes down, look at what happens. I'm seeing that the selling is exhausted. I don't see the same type of selling that, let's say, we've seen somewhere here off the top. So this type of selling produced this violent reaction. But here, selling is more exhausted. The supply is exhausted. And we see that also in the spread to the downside. And once we come into the oversold condition, which we're identifying as potential stop in action right here, then I'm thinking that there's going to be another reaction, and we would be seeing probably a reaction back into the point of the resistance. So you kind of could see that I'm explaining to you guys how I'm managing the position even when I get into some trouble. And I think this is a very important skill for us to develop. And it's not like I'm doing this all the time. This is the skill that an advanced trader needs to develop to understand how the structure unfolds and what are the most opportune points for us to act upon. So again, something that we will be discussing during the tactics in March, April, briefly, and then we're going to discuss it more during the week of practicum. So this is a very interesting case study, on all of these traits. This is just like, a godsend, because it shows to my students, first of all, the mental outlook, the analysis itself, and tactics. A lot of tactics here with this position. And therefore, it's just like in one example, you have everything, the good, the bad, and the ugly. I love it. All right, some questions here. In Shake Shack, can we assume from entry 2 at 42 the price is increasing is due to no selling? Supply available, institutions have it all. I would like if you can explain the volume signature about that entry 2, please. Okay. So entry number 2. Yeah, and the logic is correct, Eric. The increase of supply shows the increase mostly into the earnings event. And after that, supply is still relatively high on some of the bars, but then it goes down. But not only that, one thing that I want to for you to see is that not only supply is going down at this point, but demand is increasing as well. And this is also extremely important. Look at the demand on this bar, and even on this bar right here. There is a lot of demand on this bar. Again, something that we will study in the second month. But comparing this area and this area to what we've seen before into the reaction, we're seeing a definitive increase in the demand signature. So what does it mean? Institutions are coming back. They're establishing their positions because they see what? They see value. And also on this type of bars, they see liquidity. Liquidity is extremely important event for them to participate in because of their size. They are huge. They have billions and trillions of dollars. And for them to open a position, someone has to sell in order for them to buy that big position. Again, something that we will be discussing later in the course. Can we assume if we see an increase in the volume as each selling climax in the downtrend channel, that the context is fast price falling and the price is near to go up to the automatic rally? Sometimes the questions are phrased a little bit strange, so we'll work on this, Eric. We're looking at these spots right here. So increasing the volume signature, what does this suggest? Stopping action, right? So why is this a stopping action? Well, because the volume increase usually will have the increase in both, in supply and demand. We just want to understand what dominates at this point. Supply still dominates the demand, but demand is absorbing the supply on the way down, and then it's absorbing on the way up on the next bars or multiple bars. The same happens here. Absorption of the supply is increasing, but demand is increasing as well. Supply is still dominant over the demand, but that absorption, that occurrence of the demand, and then subsequent buying after that, we see that in the next 3 bars, suggests that there is value, there is liquidity for big institutions that are coming in, they are buying, and that suggests some kind of at least attempt to rally. And that's the big distinction, because if the bias is to the downside here, then the distinction is going to be that our trade is going to be just a rally. And I think that in this post-analysis, this is one of the mistakes that I made, later on with this particular stock, that, more so here than here, that we are in the downtrend, and therefore all of the trades, even if you open it at the very opportune time, which this entry was just perfect, you have to be faster getting out of the position. So the exit was relatively okay, but could have been much better. And by the way, guys, during the whole course, this is the mentality that I have. I don't like when people say that, oh, you should not be thinking about perfect entries and perfect exits. Well, I don't think this way. I don't like it this way. I don't like to think this way. What I like is for us to study where exactly we're going to come into the position, at which spots and why, and where exactly we would be exiting and why as well. And I want us to concentrate on perfecting our skills, not only recognizing what is developing in front of us, but also developing tactical skills, execution skills as to where we open the position and where we close, and for whatever reason, everything has to be logical. Otherwise, do not do that at all. All right. Dog is asking, could you speak about establishing reward and risk, as it appears sometimes using price support as stop loss leads to potential large dollar percentage loss? Yeah, so I'm going to be extremely quick here, Dog, because this is a little bit out of the scope. So on your point of entry, define your point of entry, define your point of risk with the stop loss, define the risk itself, and that's going to be in dollars here, and then define your target. So for instance, here I've defined the target from the long-term chart. I'm just showing you on this chart, this is where my target was. So the logic here was, as the price exhibits climactic action in the target zone, I'm going to exit. And that's exactly what I've done. So if you understand where your point of entry, and let's say your minimum target of, let's say, $56, and then the risk here is what, about like $2, $2.50, then you could figure out what's the potential. So $18 of reward and then $2 of risk. So what is our risk to reward ratio? It's $18 divided by $2, and that's 9-to-1. So this is a really good reward to risk ratio, and it worked out very nicely. It's a different risk reward ratio here or here, right? So we were thinking about 70 as our target, maybe slightly above as an upthrust above that, maybe 72, 73, 74. We also could use the PNF here, right, to calculate the potential. Well, it didn't work out, so it doesn't matter at that point. Why getting into the position before earnings? It's gambling. Get in after. This one is from Michael. Yes, I agree with you, Michael. And I would say that for beginners and intermediate traders, don't even do this. You know, if you don't understand how to trade earnings, just avoid them. Although throughout the course, I'm bringing a lot of evidence to you guys that earnings are actually a subject of institutional bias at the time. And I'll talk about this in the course. I'm not going to develop this into a whole discussion, Michael, right now, but you know, just let's discuss this during the course. It's just a big, big topic. Okay, another comment from Michael. So between February 6th and 9th, stopped by the resistance from the top to June 11th, no long positions until chart clear direction. Yeah, and this is what I'm discussing, Michael. You know, obviously this was ugly, and obviously a lot of the mistakes was made here. But my point here is that when you make mistakes, guys, a lot of you are, and I see because I work with so many traders and so many students, I see that you're withdrawing. And I understand this pain. It's an emotional pain. And usually as humans, we are just built this way to survive, to go away from emotional pain. And market always has an opportunity for us, you know, to produce this type of pain when we are doing something not by the plan, when we are deviating from that plan, when we are misinterpreting the what we see. And I think that's kind of like what exactly happened here in the ugly trade. But it's a very valuable lesson to all of us and to me specifically because I was trading this and, you know, just a small portion is still in that trade. What is the lesson? Well, obviously, you know, have a feedback loop into the trading plan. That's number one. Again, something that, you know, we discuss in other classes. And then secondly, figure out how to manage your position. Even if, you know, you have a loss, especially with options, you have many, many ways of how to diminish your loss. So that's the way how I look at those things. All right, let's go to the next section. Okay, let's talk about the markets. And this is going to be really quick because I just want you to understand the logic, the my logic that I look at the market and our Wyckoff logic, which by the way, each Wednesday, Bruce Fraser, my colleague, and a great Wyckoffan, and we discuss in the Wyckoff market discussion class. Each Wednesday, all of our students come to that class, submit their charts, which Bruce and I review. We discuss the markets every time, and we look at the whole market from the sector perspective, from the industry group perspective, the stocks in those groups. We look at the commodities. We have so many case studies that we go through. We talk about non-Wyckoffan topics. Bruce is an amazing storyteller, and he's been in the industry for quite some time, since 1982. So it's always amazing just to hear the stories, you know, from the past, and you know, and also listen to his interpretation. And I'm gonna show you 3 slides from the last Wednesday class, which, by the way, you can find the whole class on our YouTube channel. It was a free class last week. And look at what we've discussed during this class. All of these symbols we put up so that our students would see what's coming in our discussions. All of those were discussed last time. And currently, we have a promotion for this class. You can sign up at $79 a month, which is regular $99, and this offer is going to expire this Wednesday. So go to our website, find that class, sign up, and check it out. And check it out on YouTube, where we just posted that video, and it's a featured video. So what are we looking at here? Well, obviously, we are right here now. So I have not updated the chart. So we are coming back into a trading range or above this local climactic action, which is a bearish sign or a bullish sign. Well, it could be interpreted in either way, and we still yet to see what's going to happen. So I'm going to show you both of the scenarios. Bearish scenario and analog for the bearish scenario that I'm using here is 2007, 2008 market, where we also had the same type of upthrust action. We had the first leg to the downside that looked like a structural point of the, related to the previous lows. Then we had a rally, an attempt to create the new high and a failure. And even structurally, we kind of have it in the same way, where we see a failure as a lower high, then a potential sprint that fails. And remember, that failed signal is the best signal. So again, potential sprint, and then the failure. And how did it develop in 2007? Well, at I think in December, the last December session, which was December 16, and we conducted that session, 3 of us together with Gary Fullett, which was so much fun. Gary is like such a great Wyckoffan and just a great person, and he's just always so energetic, enthusiastic. And if you have a chance, go and check out his offerings on Wyckoff products. He is a very, very good intraday trader. He's a very good Wyckoffan and Wyckoff experts on volume and spread analysis. And Gary and I, we've conducted together a class on sprints and upthrust. That was a lot of fun and just a lot of great information. So kudos to Gary for doing all this work. So look at how we go into the oversold condition. So we kind of called that continuation into the climactic action just based on this analog. And what this analog suggests was the Wyckoff structure that we could be potentially in the trading range. That's scenario number 1, and that's a bearish scenario where we could encounter some resistance at the points of the support that we've encountered before, and then just retest, and a trading range. A trading range like this would suggest a continuation of the down move to the downside like we did in 2007, 2008, and also in 2000 and 2001. All right, let's look quickly at a different scenario. This is not necessarily the scenario that is a preferable scenario for me. I'll show you another bullish scenario that I like more. But I want to point your attention to 2 boxes here, 2 blue boxes. One of them comes in 1998. And obviously we could compare these analogs based on the economic environment and where we are in the cycle. What I like about the 1998 scenario is that it produces on a technical basis an oversold condition, and that's exactly what we've produced just recently. And this oversold condition is very significant because we have been in the secular uptrend for quite some time. So every time we've been in the oversold condition, we had out of that a very quick rally up. And if we're discussing a bullish scenario, this would be the most preferred scenario, is just for bulls to have that quick rally. Why? Well, because if everyone is so bearish, who's going to sell? Who else is going to sell if everyone is so bearish? The sentiment is so bearish that at some point If we are in the reaccumulation, this whole move to the downside will be considered a shakeout rather than a downtrend. And because of that reason, and I always look at both scenarios, by the way, and this is what I teach my students, we always look at both bearish and bullish scenarios. But if we're looking at the instances where the rally is going to be very fast to the upside, and that's going to have some elements of accumulation by institutions, then it makes a lot of sense that out of the oversold condition, institutions are going to cover their shorts, and they're going to see that big institutions are buying in, and trend following institutions are going to also participate in this rally. So one of the bullish scenarios is based on this diagonal, not diagonal, but expanding triangle, where you have different environments in the structure, where you have the reaccumulation texture with the price and the volume showing decreasing volatility, testing of the previous lows, and then the rally that fails and develops distributional structure and then has some kind of short-term downtrend. Look at what has happened in the 1960-1980 trading range in the markets. The same texture. We have the reaccumulation texture first. That suggests that from the lower low, we're going to have either a sign of strength or an upthrust. Becomes an upthrust. A lot of distributional qualities here, and then a short-term downtrend. And then out of that oversold condition, we have a pretty good rally. Well, look at the recent development. Kind of has a lot of resemblances. Reaccumulation texture with the absorption in March, April, May, and the uptrend into the upthrust that develops also into the local distribution with the short-term downtrend. So the key for this analog to work is to obviously make sure that if we're going to have a rally, it's going to be fast, and it's going to quickly bring us to at least 1/2 of the trading range. If, on the contrary, the rally will fail and we're going to have the retest and the trading range, I would favor more of a continuation scenario to the downside. Obviously, with a small asterisk here, if we're going to have something like what we've seen in 2016, then this could be another potential reaccumulation. So these are the things that we kind of routinely, Bruce and I look at WMD classes again on Wednesdays. The current promotion is going to be until this Wednesday, January 9th. All right, let's go to the next slide. And I'm going to speed up a little bit, so I'm going to slightly disregard your questions, guys, for now. Let's see at the end of the class how much time we have. Just feel like we spend a lot of time on the trades, but it was a good segment. So what are we going to learn in Wyckoff Trading course? Well, as I've mentioned, the market structural analysis, or the price structural analysis, is kind of like the dominant theme with the Wyckoff methodology. If you think about what the method covers, except for the price structural analysis, and we would be talking about volume and price. Volume and price is covered in technical analysis, so you don't necessarily have to have the Wyckoff method, to discuss supply and demand. At the same time, there are obviously some distinctions. But talking about the price structural analysis, what is there for us to explore? Well, we're going to start with the change of character, and this is an extremely important but very simplistic concept, and I'm going to show you guys how the environment changes and how we need to identify that change in order for us to understand how the price is going to behave in the nearest future. That will lead us to that price structural environment, whether we are trending or non-trending. And if we are trending, what kind of trend we are in. Then we're going to talk about Wyckoff phases and Wyckoff events. So whenever we go into the consolidation, we want to conduct a phase analysis. Phase analysis is all about identification of specific Wyckoff events and specific characteristics that belong to those events that help us to identify the bias, that help us to identify the timing of when the price is ready to leave the consolidation, and also a potential character with which the price is going to travel. So these are going to be our goals. Supply and demand is going to help us out, both, not even both, in all of that. It's going to help us out to define the bias and confirm the bias. It's going to help us out to define the timing as to when the price is going to leave. And also, it's going to be crucial in identification of the potential character of the next move. Now, if the bias is the primary concern of the beginner, the timing is definitely more of the concern of the intermediate trader. Character is all about advanced studies. So, and that's kind of like how it is with the course. We're first going to talk about the bias and timing, and then we're going to switch in the practicum into the character. One thing about the character that I will say, and then I will go away from this, character is extremely important. And in some cases, students come to me and they ask me a question, well, how can you possibly identify the character of the next move? Well, you look at the price and the volume, and it's all there. In a lot of cases, when students come to me, if the beginner comes to me and they ask me, what would you recommend me to read? What kind of books? We have all of the recommendations on our website, by the way, under the resources navigational bar, navigational button. Books that Wyckoff wrote himself, books that people wrote about Wyckoff method, and also books on technical analysis. Those are the books that we recommend to the beginners. To the intermediate and advanced traders, I recommend not to read books. And my only recommendation is to read charts, because a chart always has everything that you need. That statement by Wyckoff, where we have to judge the market by its own action, is a very profound statement for me personally. And the majority of my studies, 99% right now, as after 20 years of reading the books, reading the articles, is all about the charts. There is nothing else. So just kind of like a side note on that. Let's come back to the supply and demand. What's under there that we will be studying? Well, obviously just the volume and price analysis itself and the relationship of the effort and the result. Those are extremely important concepts. And then we will go into the details of the bar by bar analysis, or swing by swing analysis. Bar by bar is the volume spread analysis, as you know. And swing by swing analysis is extremely important, especially in the trading range. We will discuss the volume patterns of different Wyckoff phases in different consolidations, which are accumulation or distribution. And we'll talk about not only the volume characteristics, but the price behaviors for those volume characteristics. And then we'll talk about historical analogs that I use even in the course for the beginners. Then our attention will shift to the relative and comparative analysis. Relative analysis, relative strength analysis is a pretty common analysis in technical analysis, and I'm not spending a lot of time on that because usually students come well prepared, but there are some specificity, and especially contextual specificity to the Wyckoff method that I'm going to be pointing your attention to. On the top of that, I'm going to show you some of the things that I do or that I recommend to our students to do in filtering and scanning. And we will use something as simple as StockCharts engine, StockCharts.com engine to identify, that selection and to go through those filters and scans. And then our last segment is going to be devoted to trading tactics and management. And you kind of have seen a little bit of the preview with some of the trades, some logic there, this is not, and the logic that I've explained is a little bit more advanced even, and with some of the trades, we will be predominantly thinking about the points of entry, where do we open the position and why, our regional stop losses and how we move those, and then how do we exit and what are the strategies on exit that we could use. We'll talk about scaling in, scaling out, how that benefits our risk management profile, and so on and so forth. And then we'll also talk about different tactical scenarios. And this is more an analytical skill than tactical skill here. But, tactics are sometimes more useful than analysis itself. And some of the trades that I do just based on tactics rather than analysis itself. Okay, and as I mentioned before, the course duration is 15 session. We're starting today, so our last session is gonna be on April 15th. The time that we're gonna spend together is 2.5 hours, so this is 37 and a half contact hours for the whole course. Again, right now we are at the discounted price, so take advantage of that. All right. All right, well, finally, we actually starting our lecture in the material. Let's talk about Richard T. Wyckoff himself. Who was he? Well, I think that he was a fascinating character, just because of how his life unfolded. One of the most interesting pieces on Wyckoff I actually read in Stocks and Commodities. Stella Asoba's article on Richard D. Wyckoff, which I believe was published either 2 years ago or a year and a half ago, during the summer of 2017, I believe, maybe earlier than that. It's a 5-part article. I highly recommend it, not as an overview of the method itself. It probably could have been more in depth, although I think that Stella did a good job, talking about the method itself as well. But it was so fascinating to read about the life of Richard D. Wyckoff. He was an editor. He was a trader. He was, an acquaintance to such big operators as Jesse Livermore, Herman Cain, Kahn, and obviously he lived in the era when J.P. Morgan was conducting his campaigns. And what he did is he followed those stock market operators, and he was collecting the data on their trades, interviewing them, and trying to extract their best practices on how they conducted their campaigns. And the whole course and the idea of institutional presence, which he called the composite operator, is just based on his observations of those people. And it's just fascinating to think that he had access, sometimes direct access, or through the interviews of just living through that time and collecting the information on such amazing traders, at that time. And he codified all of those practices into the course. Unfortunately, his personal life was somewhat hectic, and he died relatively young, I think. For our time, maybe it was okay back then. He died in Sacramento in 1934, 34, and after the third marriage, which failed, and where his wife took the possession of almost everything. And I think that he was forced after the divorce and into the early 30s, to create something else. So his magazine of Wall Street was taken away from him. His real estate holdings were taken away from him. His family was kind of ruined in a way, and he had a very bad health at the time. And I thought a lot about this, and sometimes I feel like, I kind of like, talking to him, obviously, from my mind, and projecting what he would answer to me, and talking to him and discussing, his life and, what has been happening during that time. I felt that he was forced to write the course. This next, this slide right here, the course that he has published in 31, 32, 33, 34. That's the main course that is left for us, that is more sequential as an educational piece. Now, whenever students ask me, and first of all, you could find this online. I believe this is in the public domain right now. Whenever students ask me, do you recommend to read this course? For the beginner, yes. But if you have a chance not to read that course and read it later, I would rather you do that. And there is a reason why. Because that particular course is somewhat outdated. And my recommendation, if you want to read on Wyckoff, read Bruce's blog. And I've mentioned Bruce already multiple times. So Bruce conducts a WMD session with me on Wednesday. Bruce is a blogger on stockcharts.com. A lot of you know that. A lot of you read his blog. But for those of you who are not familiar with his work, please go to stockcharts.com, find his blog. It reads as a book. I'm trying to push Bruce to publish his blogs as a book. That makes a lot of sense to me. So we'll see how that's going to go. But all of our students are required to read his blogs, whether you're going to start from the beginning, and sometimes it reads as a book. He goes through the analysis, and there are sequence of blogs on specific instruments that he has, or sequence of blogs on the specific concepts, and so on and so forth. This is definitely a must read, and I would say even before the Wyckoff course itself. So you could definitely study Wyckoff methodology through his blogs. If you don't want to read, come to the classes. If you want like more details, more in-depth, and more interactive stuff, then obviously a class would be the best. But definitely check out Bruce's offerings. All right, let's come back. Well, Wyckoff himself, I thought, was not only a great trader, but he was a really good businessman. And sometimes people disregard this, but because I'm in this business, I understand how hard it is to conduct this business, because you always on record. And as you could see, even today, I'm showing you the trades, and somebody's going to say, oh, you shouldn't be doing this, or you shouldn't be doing this, and so on and so forth. So you kind of constantly being bombarded by the feedback of people. And I have a lot of respect for people who do this job, and for Wyckoff himself, because he was such a pioneer in this business. And at one time, he had over 200,000 subscribers. We don't have so many people subscribing to our current services, I must tell you right away. But you know who did that? William O'Neill. And that's why I have a lot of respect for William O'Neill as well. And we know that William O'Neill, on the technical side of CAN-SLIM system, used a lot of Wyckoff ideas. And we saw this as a confirmation, from, the comments of somebody like Chris Catcher or Morales and other people. And even when you look at some of the William O'Neill trades, not the ones that are breakout trades necessarily, but the ones that are long-term trades, they are very much Wyckofian. And we'll talk a lot about, you know, the differences between the CanSlim entries and exits and Wyckoffin entries and exits. There is a lot to learn there in the differences. Um, I have a lot of students from counseling that come and actually really enjoying and benefiting the knowledge of Wyckoff methodology just because it allows them to be a little bit more in control on the technical analysis side of things. It's definitely more in-depth studies on the technical basis. And look what Wyckoff have done. He was publishing the ticker. And here, this is so cool, an article with William D. Gann. And that just tells you, like, he was living in such an amazing time for technical analysis, where Dow was creating his theory, where Elliott was, creating his structural theory, where Gann was making all of this trades and just amazing material that he was publishing. And he was living with in the times of such amazing stock market operators. He later on became an editor of the Magazine of Wall Street, just a very big subscription. And this is so cool to see also Western Union, Telegram. And then he published quite a few books. Now, also a question about the books. Should I read the books? Yes. If you're a beginner and intermediate Wyckoff, you should definitely have those. They are not necessarily the books where you could extract a systematic approach to trading, but you will find a lot of the great advices and some of the elements on tactics as well. You just would have to read all of this and extract this information from those books. Again, if you want a shortcut to the knowledge, then start with the course, read Bruce's blog, read specific books that I'm giving you, and this is my advice for the beginners and intermediate traders, Wyckoff traders. For the advanced traders, my conversation with you is going to be slightly different, and it's going to be more about, let's put the chart on and let's talk about it. Let's analyze it and let's figure out the way to understand it better. So that's the way how I teach. All right. Let's talk about the composite operator. So what is this concept that Wyckoff talked about? Composite operator, or like Gary always would say, a composite man. Well, a composite operator or composite man is a heuristic. It's a device that helps us to understand how the price structure is being formed and why. So I'm going to translate this into modern terms. We're basically talking about large institutions as a group of investors and traders that influence the price structure in a very big way. Because of their huge size, and think about something like PIMCO or Warren Buffett or BlackRock and multiple other huge institutions. And they could be hedge funds, they could be banks, they could be any type of financial institutions like pension funds, insurance companies. And by the way, those have so much money. And I worked with institutional investors, and I still do. And it always surprises me, the size that they have, the requirements that they have for trading. It's a different type of trading than retail trading. So all of those institutions, if they're conducting their campaign the same way, they are becoming a big force behind the buying and selling in the markets. And that's what moves the price. And that's what absorbs the supply. And that's what creates points of liquidity where they operate. And Wyckoff called it a composite man. And the assumption was that because of the size, they can dictate the potential buys of the next move, which is absolutely true. The more money you have, then the more you invest into the stock, the more you control. So he called it a composite, man. He was suggesting that multiple stock operators could be marking up or marking down the price and conducting those campaigns. In nowadays, I am talking only about the institutions. I will mention the composite man or the composite operator, and you should be able to understand this concept. All right, let's talk about the price cycle. And we also will go into the case study on Apple, where I'll show you how specifically at that spot Apple was selected and how the trade was conducted. But first, let's talk about more of the theoretical price cycle. So as we've talked about the composite operator, I also want to talk about the difference between strong hands and weak hands. We usually would be thinking that, and this is how we unfortunately were told or taught, that the weak hands are always public hands. This is absolutely not true. And actually, if that would be true, the market would have a different look and a different structure. The weak hands could be both public and institutional hands. And as I worked with institutional traders, I must tell you guys that institutions are like us, skin and bone. They are human as well. They are driven by the same emotions that we have. They have the same brain. The only difference between them and us, a couple of things. First of all, it's their 9-to-5 job. That's number one. So they devote much more attention to what they do. Secondly, they have an enormous size, an enormous edge in how they receive the information. And those are the advantages that kind of propel them in a lot of cases to the strong hands. But every year, in every type of market, since I started, teaching, trading, learning this stuff, working in the financial field, every year I read the articles that over 90% of all of the hedge funds are failing to outperform the markets. And that's why the latest idea, and I love Warren Buffett's idea, is that you might as well, in the secular bull market, just invest into the ETFs, market ETFs. You could make a more selective trade like this based on the sectors and groups, not specifically stocks. But it's been very, very successful. And as we know, Warren has won a bet that lasted for like 10 years, I think. $1 million that ETFs, market ETFs are going to outperform. That was a very low risk bet. And obviously, Warren knows a lot about that stuff. So we could see how sometimes we could confuse institutions with strong hands. I don't want you to think this way. I want you to restructure your thinking here and think not in terms of institutions and public, but in terms of strong hands and weak hands. And then we're going to say that usually strong hands are going to be the composite operator. Composite operator is going to have huge size. And the time frame for the composite operator is always going to be a business cycle and beyond that. Think about Warren Buffett and his average holding period for a winning or even non-winning stock. It's not a year. It's not 2 years. It's not 5 years. It's a decade or two. I mean, some of the holdings that he has had throughout his career, it's just been there for a long, long time. So this is the trait and the characteristic of the composite operator. Why is this important? Well, because their behaviors are going to be based on the needs that they have. They have a need to establish a huge, sizable position, and they need to hold on to this position for quite some time. They cannot go in today and close the position tomorrow. It wouldn't make sense to them at all. The taxation problems that they will incur, that's number one problem. And then the portfolio rotation, that's number two problem. And then just generally going in, going out, as you might know even from your own trading, is very dangerous because you increase in the number of mistakes that you make. And these are the things that I'm hearing from institutional clients that I have, that those are the big things that they pay attention a lot. Then we're going to have, after the composite operator, which is basically a contrarian in a lot of ways, we're going to have a lot of institutional trend followers. Those are also big size institutions, and they usually look at the market cycle time frame, meaning that their positions are probably going to be beyond a year. This is going to be favorable from the taxation point of view. But they're going to be acting a lot as a composite operator and jump on the emerging trend and jump off the trend once they see the signs of deterioration. And they're going to pick up the time frame that's going to allow them to park the money for quite a long time to ride the whole uptrend and then distribute either on the way up during the consolidation or on the way down. And that's what produces this compounding effect and big profits that they accumulate throughout the years. Also, on the strong hands side, we're going to have professional traders. And here under the professional traders, I probably should mention that there are pros that are institutional pros, and then there are retail pros. Obviously, institutional pros are going to have, somewhat a larger size, but a very serious retail professionals are going to be having also a good size. A good professional is not going to have a small size on equity just because it doesn't make sense. With the risk management, you have to control the risk in a specific way, so you can't commit all of the capital, to a specific position or to, a few positions. You're gonna, control your risk and portfolio risk through some of the techniques that they have, and therefore you have to have a size. So this is still a very sizable group that is a professional group, and in a lot of cases they could be strong hands and be on the right side of the bias. On the weak hands side, we're still going to talk about the retail traders as the public, but we also will talk about institutional and professional managers. And I mentioned to you just a minute or so ago that those people could be wrong too. Our first assumption, when we started studying Wyckoff methodology, that strong hands, institutional hands are always correct. Well, that's not right. I've seen it myself. I mean, I've coached them. I've mentored them. I've taught them the method. I saw their mistakes. A lot of them are just, like us. They just have more time to devote to this craft. And, as we in any profession, somebody is good, somebody is better, and somebody is not that great. And this, the market is unforgiving. The clients are unforgiving. So if you're not progress with your studies, understandings of the market, and your execution, you will be out really fast. So let's look at the price cycle itself. And now let's try to understand the behaviors of strong and weak hands. How would they behave at different spots of the price cycle? Well, first of all, the price cycle itself is just a representation of the accumulation period under the oversold condition, where the sentiment changes from bearish to bullish. That goes into the markup phase based on the absorption of the supply and not availability of that supply by institutions throughout the markup phase. And then into the area of the distribution, the area where um, a big, strong hands are going to start distributing the stock. And that's going to be in the extreme overbought condition, and where the sentiment is going to start shifting like